Jesus.
S&P 500 program trade buy level 1.
It's your wake-up call, pal. Go to work.
Well, there's a bit of news going around about tariffs and related policies right now. You'd have to be on Mars to miss it. I don't think we need to ramble on about the appropriateness or the market turmoil that's followed. Instead, I thought it would be useful to offer a little foundation knowledge. So today we're diving into a fascinating corner of economics that affects everything from the price of your morning coffee to the performance of the stock market. Welcome to Trading with GB. I'm GB, obviously, and in this episode we're going to unravel the connections between tariffs, the fundamental economic principle of comparative advantage, and how these forces can ripple through interest rates, the stock market, and the value of currencies. Think of it like this. Global trade is a complex web, and tariffs are like detours, speed bumps, or even roadblocks on that web. Understanding how these barriers interact with the natural flow of trade, guided by comparative advantage, is crucial to grasping some of the major movements we see in the financial world. So buckle up as we demystify these concepts and explore their surprising interconnectedness. Let's get started. Let's start here, understanding tariffs, the basics. Let's begin with the most direct player in our story, tariffs. Simply put, a tariff is a tax imposed by a government on goods and services imported from other countries. Think of it as a customs duty when a company in, say, Germany wants to sell its cars in Australia. The Australian government might impose a tariff, a certain percentage or a fixed amount on each car that crosses the border. This extra cost then usually gets passed on to the consumer, leading to higher prices for those imported goods. In Australia, we have a thing called a luxury car tax, and given we don't actually make any luxury cars, then that tax is effectively a tariff, kinda, although that is not its intent. Now, why do governments actually impose these tariffs? There are several key reasons. One of the most common is protecting domestic industries. By making imported goods more expensive, tariffs can make locally produced goods more competitive. For example, a government might impose a tariff on imported steel to help its own steel manufacturers thrive. And another reason can be generating revenue for the government. While this isn't always the primary goal in developed economies, tariffs can be a significant source of income for some countries. National security concerns can also play a role. A country might impose tariffs on goods deemed strategically important, like certain technologies or defense-related materials, to reduce reliance on foreign suppliers. Finally, tariffs are sometimes used as a tool for retaliation. If one country believes another is engaging in unfair trade practices, it might impose tariffs on their goods as a way to pressure them to change their policies. It's worth noting that there are different types of tariffs, though we won't delve too deeply into them today. You might hear terms like ad valorem tariffs, which are a percentage of the imported goods value, specific tariffs, which are a fixed amount per unit, or compound tariffs, which are a combination of both. The key takeaway here is that tariffs are essentially a tax on imports, designed to influence trade flows and achieve specific economic or political goals. The law of comparative advantage, the foundation of trade. Now, to truly understand the impact of tariffs, we need to grasp a fundamental principle that underpins much of international trade, the law of comparative advantage. This might sound a bit academic, but the core idea is surprisingly intuitive and interesting. Imagine two countries, let's say Australia and New Zealand, and two goods, wool and wine. Australia might be able to produce both wool and wine more efficiently than New Zealand, meaning it takes fewer resources to produce the same amount of either good. This is called an absolute advantage. However, the law of comparative advantage focuses on opportunity cost. Opportunity cost is what you give up to produce something else. Even if Australia is better at producing both wool and wine, it might be relatively better at producing wool. Perhaps for every extra unit of wine Australia produces, it has to give up producing a larger amount of wool compared to New Zealand. Conversely, New Zealand might be relatively better at producing wine, even if it's not as efficient as Australia in absolute terms. The law of comparative advantage states that countries should specialize in producing the goods and services for which they have a lower opportunity cost, and then trade with each other. In our example, Australia should focus on wool production and New Zealand on wine production. By specializing and trading, both countries can actually end up with more of both goods than if they tried to produce everything themselves. This leads to increased efficiency, lower prices for consumers, and a greater overall global output. Now, think about tariffs in this context. Tariffs act as a barrier to this efficient allocation of resources. By artificially increasing the cost of imported wine, in Australia for instance, a tariff discourages Australians from buying New Zealand wine, even if New Zealand can produce it more efficiently in a comparative sense. This disrupts the natural flow of trade driven by comparative advantage and can lead to inefficiencies and higher costs for consumers. The impact on interest rates, stocks, and currency values. We've established what tariffs are and how they can run counter to the benefits of comparative advantage. But how do these trade barriers then ripple through the broader financial markets, specifically affecting interest rates, stocks, and currency values? What does it mean for traders? Let's break it down. First, consider interest rates. Tariffs can contribute to inflation. When imported goods become more expensive due to tariffs, businesses that rely on those imports face higher costs. These costs are often passed on to consumers in the form of higher prices for finished goods and services. If inflation rises, central banks might feel pressure to raise interest rates as a tool to cool down the economy and bring inflation back under control. Conversely, tariffs can also harm economic growth. By increasing costs for businesses and potentially reducing the volume of international trade, tariffs can slow down economic activity. In a scenario of slowing growth, a central bank might be inclined to lower interest rates to stimulate borrowing and investment, although this becomes complicated if tariffs are simultaneously causing inflation. Furthermore, the uncertainty surrounding trade wars and the imposition of tariffs can decrease investor confidence, leading to capital flight and potentially influencing central bank decisions on interest rates. So does it lower rates or raise rates? Do you sell bonds or buy bonds? Time will tell, and of course the devil is in the detail, as they say. However, as a general point, you could argue the fear will hit the market first, and in this instance it's fear of harming economic growth. That's bond price positive. But over time, as new tariffs kick in, the economic impact becomes clear. Rates will adjust. If it pushes up prices, then we'll see rates move higher. So for sure, that fear factor is playing out in bond prices. But time will tell if it sorts itself out. Next, let's look at the stock market. The impact of tariffs on stocks can be quite direct. Companies that rely heavily on imported components or raw materials will likely see their costs increase due to tariffs, potentially squeezing their profit margins and leading to lower stock prices. Similarly, export-oriented industries can be negatively affected if other countries retaliate with their own tariffs, reducing the demand for their products and impacting their profitability and stock valuations. However, it's important to note that some domestic industries might actually benefit from tariffs that protect them from foreign competition. These companies might see increased demand for their products, potentially leading to higher profits and stock prices. Overall, though, widespread tariffs tend to create volatility and uncertainty in the market as investors grapple with the potential winners and losers and the broader economic implications. Finally, let's consider currency values. Tariffs can influence the demand and supply of currencies. For example, if a country imposes tariffs, its demand for foreign currency to pay for imports might decrease, potentially leading to an appreciation of its own currency. However, this is often offset by other factors. A country's balance of payments, the difference between its exports and imports, can also be affected by tariffs. If tariffs significantly reduce imports without a corresponding increase in exports, it could impact the demand for the country's currency. Furthermore, international investors' perception of a country's economic stability and future prospects can be influenced by trade disputes and tariffs. Increased uncertainty might make investors less willing to hold that country's currency, potentially leading to a depreciation. And of course, retaliatory tariffs can further complicate currency valuations as trade relationships sour. Real-world examples and nuances. Host, To bring these concepts to life, we can look at recent history. For example, the trade tensions between the United States and China in recent years saw the imposition of tariffs on a wide range of goods. We observed how this led to increased costs for some businesses and consumers, contributed to market volatility, and sparked debates about the potential impact on inflation and economic growth. Certain sectors that were protected by tariffs saw some initial benefits, while others heavily reliant on international supply chains faced significant challenges. It's crucial to remember that the actual impact of tariffs is rarely straightforward. It's influenced by a multitude of other factors, including the overall health of the global economy, other government policies, and unforeseen global events. Predicting the precise consequences of a tariff is a complex task, and economists often have differing views. What might seem like a simple measure can have far-reaching and sometimes unintended consequences across different sectors and financial markets. And here's another thought. If tariffs and other protectionist policies were used purely as an economic tool, thinking through how this is going to affect the market might be an easier task. But that thing called politics gets in the way. It's not uncommon to see a country use a tariff as more of a threat than an economic tool. It becomes a bargaining chip. And that means there's uncertainty as to how long a tariff might be in place, and that of course has flow through to its possible effect on things like infrastructure and domestic production. In other words, it muddies the water. Finishing up, key takeaways and final thoughts. So let's recap. We've explored how tariffs, essentially taxes on imports, act as barriers to international trade. We've revisited the law of comparative advantage, which highlights the benefits of specialization and trade based on lower opportunity costs. And we've seen how tariffs can disrupt this efficient flow, potentially leading to higher inflation and influencing central bank decisions on interest rates. Furthermore, we've discussed how tariffs can create winners and losers in the stock market, often leading to overall uncertainty and volatility. Finally, we touched upon the complex ways in which tariffs can affect the demand and supply of currencies and a country's overall economic perception in the global market. The key takeaway here is the interconnectedness of the global economy. A policy like imposing a tariff, which might seem targeted at a specific industry or country, can have significant ripple effects across various financial markets. As informed citizens and investors, it's important to pay attention to trade news and consider these broader economic implications. Thank you for joining me today on the show. I hope this has shed some light on the fascinating interplay between tariffs, comparative advantage, and the macro markets. All right, let's finish up. A quick word from my website sponsor, and I'll catch you next time. Okay, let's talk about Masterclass again. If you're interested in advanced trading material, check out masterclasstrader.com. We have courses on trading commodity spreads like a hedge fund manager, trading order flow like a prop trader. And for a limited time, you can use the code TradingWithGB for a 20% discount at the checkout. One word, Trading with GB, the website again, masterclasstrader.com. Get 20% off